If you've ever looked at the investment options in your 401k, you've probably seen target date funds. In fact, you're probably invested in a target date fund and you might not even know exactly what that means and exactly what it is. So if you go through your 401k options, typically where you're going to see target date funds, you'll see a list of all these kind of normal funds, and then you'll see another list of all these funds that have dates at the end. 2045, lifestyle, 2046, 2050, 2055, 2060. On and on and on, you'll see this big list of funds, maybe 10, 20 of them, and they all have dates at the end. They all have these years, and you're not really sure what they are, but you're probably invested in it because you understand that they're going to invest your money and the allocation is going to change over time. And that's usually what people understand of target date funds, but they really go a little bit deeper, and you need to understand a little bit more about target date funds before you start investing in them. So let's look at a brief history of why target date funds even came around. Before, people would invest in their 401k, but they would just put money in there. And when they would go back and look, and when I say they, I mean the people that would study 401ks and administrators and stuff like that, when they'd go back and look, they'd see that there's all this money in this 401k, but nobody's actually invested in anything. And that's because people aren't stock pickers. People don't understand different types of funds. They're worried that they're going to pick the wrong fund, they're going to lose their money, they're worried that they're going to pick the wrong fund and not make enough money. And they see this huge list of stocks, and you can build retirement accounts to be 10 items to choose from, 10 investment items to choose from, or you can have up to like 40 different investment options to choose from. And what happens is people get paralysis by analysis. They see this huge list, they're not really sure what they're looking at, they're not really sure what they need to understand, and they don't want to be stupid by picking the wrong thing. So they take this perceived notion that if they pick the wrong investment option, they're going to be stupid, they're going to lose their money, and they're not really sure. So what do? They don't pick any investment options. So they just stick with cash. And it's all good and well to invest in a 401k because, again, you have the tax benefits of putting money in and getting the deduction on your taxes now. But if that money's not growing over time, then it doesn't really matter that you put money in now and you got the tax deduction. So people really need to invest their money in their 401k. Make sure you go back and look at your own 401k at the end of this video and try to understand what you're invested in and see if your money is invested in at all. So what they needed was an instrument that people could invest in, that people felt good about, and that they would actually invest their money in. In 2006, one of the pension acts at the time told 401k plan administrators, the people who run the 401k, that you could auto-enroll people into investment options. There was a default. If the participant, you, didn't pick an investment option, you would be auto-enrolled in this investment option. This opens up a lot of liability for the company because they don't want to invest everybody in this really aggressive fund and then it lose money and then all their employees quit, sue them. That's a big mess. So they needed another option, another investment vehicle that they could invest in that they felt good about, and that's how target date funds came around. So now that you know the history of target date funds is to help 401k participants, you, invest in the market and actually invest their money into something, now you need to know what a target date fund is. Most people understand that target date funds are actively managed. And what we mean by that is there is a manager that's actively buying positions and buying fixed income bonds and buying equities. Now you look at a passive managed fund like an index fund, something that just tracks the S&P 500 or the broad market. This is passively managed. It just follows the market and that's it. A target date fund is more actively managed. It actually has a column of equities that it buys and a column of fixed income or bonds that it buys. And that allocation depends on the retirement date and what we call the glide path. Now we'll get there in a second. So a target date fund, what it does is it sets an allocation at the beginning. Usually when you have 20, 30 years into retirement, it's going to be aggressive. And then as you get closer to retirement, they're going to change the allocation from being heavy on the equities to being lighter on equities and heavier on bonds as you get closer to retirement. This is going to take an aggressive portfolio and slide it down into a more conservative portfolio as you get closer to retirement. People understand that they need an aggressive portfolio now to make money, and they need a conservative portfolio at retirement so they don't lose all their money. You don't want to make money now, and then when you get close to retirement, you lose all your money, and then you can't retire. So they needed a way to make this happen without actually having people go in and make the trades themselves. So that is what a target date fund is. It starts aggressive when you still have a lot of years left into retirement, and it fades down into a more conservative portfolio over time. And usually that's 10, 20, 30 years. It just depends on the date you pick when you set up your target date fund. All those years that you see, the big column of investment options with the years, you're supposed to pick when you think you're going to retire. So that's when the portfolio is supposed to start getting more conservative, or actually be conservative, is at that date. So you want to pick the date that you're actually thinking about retiring. So there is still a ton of confusion around target date funds. In fact, they did a study to try to understand what people were not understanding about target date funds. Now, 72% of the participants understood that target date funds get more conservative. Yes, that is true. Again, they start very aggressive when you have lots of years left in retirement, and as you get closer to retirement, they will get more conservative. They never get more aggressive. I've never seen a target date fund get more aggressive. They kind of stay at a baseline, and it's just going along, and then if your retirement's here, it'll start coming down and getting more conservative until you hit your retirement date. Now, in that same survey, 48% of participants thought that target date funds, by investing in those, would meet their income needs in retirement. I'm gonna already tell you that is not true. One, a target date fund is just a retirement vehicle. It's just an investment option. They do not know how much you're going to need in retirement. They cannot meet those income needs. Not only that, but how much you invest into a target date fund really depends on you. And if you invest more, then it has a better chance of meeting your income needs. If you invest less, it has a less chance of meeting your income needs. A person who invests $20,000 a year into a target date fund is not going to have the same benefit at the end as somebody who's only investing $1,000 a year into a target date fund. So target date funds are not there to meet your income needs in retirement. They are just an investment vehicle. They're just an option to pick from that'll invest your money for you. 65% of the participants thought the target date funds would end up in 100% cash. That is ultra conservative, because cash doesn't really gain anything in the market. And so they thought that this fund would start really aggressive and then just shoot down into 100% cash. I can already tell you that is not true. No target date fund is going to end up in cash. They're usually going to end up in an allocation that is more conservative, such as like a 40-60, where it's 40% equities and 60% bonds. But at no time will it end up as 100% cash. That money is still invested. And in fact, that came as a really big surprise to a lot of people that had their target date funds set at like 2008, 2007, 2009. When the market crashed, they thought their funds were going to be okay. They thought their target date funds were going to be 100% cash when the market crashed, and they thought they were going to be just fine because they were out of the market. And what they quickly found out is that is not true at all. Their money is still heavily invested. It's just invested more into bonds than it is into equities. But bonds still go down in market recessions. They just might not go down as much. So they still lost a lot of money by not understanding what a target date fund was and what they were invested in. Of that same survey, 67% of the participants thought that target date funds were insured by the government. That is 100% not true. No investments are going to be insured by the government. You take risk when you invest your money, and this is the same as investing in a target date fund. You take the risk that you're going to lose money. You need to understand that there is no free lunches or no guarantees in the market. If you want that, you have to go to cash and you have to just invest in interest rates. But again, target date funds are not insured by the government. What makes target date funds really complicated is that there's really two types of target date funds. The first type is what they call a to fund, and the second type is what they call a through fund. And unfortunately, there's not an easy way to tell the difference between which fund you're looking at when you're just looking at your investment options. They're not going to ever say that this is a lifestyle to fund 2045 or the lifestyle through fund 2045. So they'll never say which one's which. In fact, you'll have to go digging deep inside the performance, inside the allocation buildup of these funds. what is the difference between a to fund, like TO, and a through fund? To fund and through fund describes how the glide path will be. So what is a glide path? A glide path is the path that the portfolio will take to go from being very aggressive to being very conservative. This downward motion as it gets more conservative is a glide path. What happens is you start with, let's say, 80-20. 80% equities, 20% bonds. And over time, you're going to get to 40-60. 40% equities, 60% bonds. That just doesn't happen overnight. So they don't get to your retirement year and then they sell a bunch of their equities and buy a bunch of bonds, and it goes from being 80-20 to 40-60. It doesn't work where it's just one day. What happens is over the years, it will get more and more conservative until finally it gets conservative at the end, and then it'll just kind of stay that way until it's done trading. So a to fund, that glide path, is going to get the most conservative at your actual retirement date, the actual retirement year that you picked in the fund. So if it's a 2045 and your fund is going to get to 40-60, 40% equity, 60% fixed income, it'll do that in 2045. It'll get to 40-60 in 2045. That is when it's most conservative, and it'll ride that 40-60 until it's done trading. So that is a to fund. The glide path goes and it hits the most conservative point at the year that's listed on the actual fund. So 2045 in our example, that's when it's most conservative, and then that's when it's set. A through fund is going to shoot through your retirement date. And when I say retirement date, I always talking about the date on the actual investment of a target date fund. So again, let's look at that 2045. Still, we're looking at a very conservative 40-60 portfolio. But in 2045, it is not going to be that 40-60 portfolio. It may be a 60-40 portfolio, where it's 60% equities and 40% bonds. And in 10 years after that retirement date, so in our example, 2055, 10 years after that retirement date may be the time that it actually gets fully conservative of that 40-60 portfolio. So if this is your retirement date, think of right here, here's your glide path. That glide path is just going to shoot right through your retirement date and finally get conservative 5, 10, I've seen them 15 years past your retirement date is going to be ultra conservative. So this is a more aggressive portfolio because it is not going to get conservative as quickly. It's going to extend its portfolio even further out in time. You really need to understand which kind of portfolio you're investing in, because if you get to your retirement date and you think you're ultra conservative, but you're in a through fund and the market tanks, you're gonna wake up to a very horrible surprise that your portfolio is down a lot more than you actually think. So the difference between a to fund and a through fund is when it becomes the most conservative, when it finally reaches its final allocation. A to fund is going to do it on the date listed in the fund. A through fund is going to do it 5, 10, even 15 years past that date that's listed in the fund. How do you know which fund you're in? You can go to the prospectus. You can look it up on sites like Morningstar, Vanguard, and you can look for the glide path, and they will show you the actual glide path and how it changes over time. There'll be a big 0 at the bottom, and that is the retirement date. If it becomes the final allocation at that 0, you're in a to fund. If it becomes a final allocation after that 0, you're in a through fund. Usually, when investment options in a 401k are made up, they're made up of just kind of one fund family. So all of the target date funds are all gonna be the same kind of fund family, which means that if one is a to fund, all of them will probably be to funds. If one is a through fund, all of them will probably be through funds. And unfortunately, there's just not an easy way to tell the difference. I wish they would just make a little notation there in the investment name, to or through. Make it real simple. That way people know exactly what they're investing in. So with all this talked about of target date funds, should you invest in a target date fund? Maybe. Target date funds are not bad investment vehicles, especially if you just want to be hands off. They can be a little bit more conservative at the beginning than a lot of people would like to be, but they don't have to worry about changing their allocation over time. They don't have to worry about trying to pick the right funds out of this other huge list. They can just buy one target date fund and then just kind of let it run into their retirement. Again, you should try to understand if it's a to or a through fund, but there's nothing inherently wrong about investing in a target date fund, especially if you just want to be a hands-off investor. It is always better to invest in something than nothing at all. So you don't want a big portfolio of cash, you actually want to invest your money into something. And if you just don't want to sit there and go through the stocks, or you don't want to work with a financial planner to try to understand which stocks you should invest in or which funds you should invest in, then pick a target date fund that lines up to the year that you want to retire. I suggest you revisit this throughout the years and make sure it's doing what you expect and what you want, especially as you get closer into retirement. Again, you don't want to think you're in a conservative fund that's not conservative and you find out the hard way like the people in 2007, 2008, and 2009 did. You don't want to have to delay your retirement because you did pick a bad fund and because you didn't understand the final allocation and when that was going to happen. But getting started in your investments, it's not a bad idea to just invest in a target date fund just to get you going before you can actually sit down with somebody and understand your investment options, or maybe you just want to learn yourself and understand your investment options a little bit better. I'm Adam Beatty, Certified Financial Planner with BullLogic Wealth Management. Please make sure you're clicking the logo over here to subscribe to our channel. Also click the bell to make sure that you are getting notifications when we release new videos.